So I think the impact on the economy is real, Scott. I think, the impact on the financial services industry is real. I suspect that we're probably overestimating the short-term impact, but we're probably underestimating the long-term impact. And I think, there are real consequences to having a crisis such as we're having right now.
You think the market has overreacted?
So I don't really look at it as much from a short-term perspective, but I think if I look over a period of time, it does not feel at all, because of the impact that we're going to have on the economy, that the market has bottomed. But I would not at all be surprised if we saw a very healthy bounce down the road. And I think we have had crises before. I feel confident that if we have the right targeted fiscal investments, if we have the right governance around this, that we can see through this crisis. And I think if we do, the underlying economy is pretty strong, and I can see a very healthy bounce. But I don't see that bounce in the very short term.
Joe, let's go with that. Tobias Lefkovich over at Citi, uncertainty is the mother of all market woes. We still think it's too early to jump in. He says UBS, while it's not our base case, a, quote, garden variety recession is possible, could send the S&P down to 2,500. There's commentary like that throughout the street today. So how do you see it based on what Bob said and what the prevailing thought is and the way that the market gain evaporated today?
Yeah, I think, Scott, you asked me the other day if I felt this was a process, and absolutely it is going to be a process, and I don't know why we can't accept that as an investment community. If you think about the violence of the sell-off that we experienced in the last week of February, historically it scores as the fourth of the 5 greatest one-weekly sell-offs in the history of the markets. And if you look at those other incidences, you're talking about 1987. You're talking about after TARP was actually passed in October of 2008 when the market fell in 1 week 18%. You're talking about 2000, 2001. In each of those circumstances, it took 2 years. That was the shortest duration. 87, it took 2 years to recover. So other situations, it took 7 to 5 years. So I think we just have to accept that this is part of a process. I absolutely agree with what Bob is saying in terms of there will be a recovery. I think in the near term, unfortunately, we've lost the focus on where the flows of capital are actually going and the biggest problem. And as a former CEO of a bank, Bob, I have to ask you, it seems as though we are flirting with negative rates. How would you feel about negative rates as a former bank CEO? And is that a place that we want to go?
Well, look at Europe. I mean, the banks are still have asset issues, still have real serious earnings issues. You look at the U.S., and this is not a banking crisis. When we sit and compare and contrast this to 2008, when it was truly a banking crisis, as we all remember, Morgan Stanley, Goldman Sachs, B of A, Merrill Lynch, all of them were insolvent without serious monetary stimulus and the TARP program and other things that went on. Today, we look at the U.S. banks, and they're down 30 to 40% from the peaks, but they're very, very healthy. Liquidity is good. Capital levels are good. So I think we have a very strong banking industry here. And compare and contrast that to what's going on in Europe. To get to the core of your question, I don't think serious policymakers believe that going to negative interest rates is a good thing. And I think that the policymakers, both in the U.S. and the U.K., are going to avoid it. But certainly this crisis raises the percentage chance. It's a non-zero probability that they may have to go there.